Hi, everyone. It's Rob. It's October 15th, 2018, and I'm going to be talking about total vehicle sales. And this will be added to the Basics in Personal Finance and Economics series. So, today we're going to be talking about vehicle sales and how they can be a measure of overall economic health and how they can be an indicator of recessions and how deep a recession may be when those vehicle sales come down. As you can see in the chart, we reached a trough of just over 9 million vehicles sold during the last recession. Previous to that, we had been in the 17 million range and then it peaked above 20 million a couple of times. So you could say that on average about 17 to 18 million units before the recession. And it looks like we got almost up to that in 2015. We got to a peak of about 18.2 million and then fell off to where we're about 17.8, 17.9 million. So we're about 400 to 500,000 off of our cycle peak in 2015, but we're at about where we were pre-recession, pre-2008, Great Recession, when you had the Lehman issue and the mortgage market issue. So what does that tell us about the market? It looks like for sure we've reached a plateau and we're probably not going to get any higher. But the recent weakness in the auto market, along with the recent weakness in the real estate market, is an indicator that the consumer is leveraged out and doesn't have any more room to take on any more debt. So we'll talk about that here in just a moment. First, though, I wanted to talk about this increase since the last recession. How did we get to this increase? Well, the story goes that the manufacturers were really suffering, as a lot of people were during the recession, and they needed to increase sales. So along with the cheap credit provided by the Fed, easy access to money, the dealers also enacted zero-rate car loans, so basically saying no-risk car loans, and also enacted big dealer incentives that they passed on to the dealers and the dealers passed on, in many cases, to the consumers. And that decreased the overall cost of the vehicle, both from a financing perspective and from a total price perspective, which allowed more people to buy vehicles. Even though we've lived in that environment for about the past 10 years, it looks like the consumers peaked and can't really get above the current mark where we are. In fact, it's fallen down since 2015. So we've had about a 3-year slight fall in the overall number, and that's long enough to indicate that we've reached the peak and we're now on the downward trend. So I don't think that we're going to see increased auto sales, and that means that we probably reached our peak in this business cycle for overall productivity of the economy. Expect a recession is coming. By itself, this wouldn't predict a recession, but it's one large indicator when you add it to the other things that we've already looked at. And now I want to move on to the second piece of the analysis, which is looking at world production, because certainly the U.S. manufacturers produce for the rest of the world, and the world producers sell across the world, including the United States. So we can't just look at total vehicle sales in the U.S. Now, prior to getting into the numbers around the rest of the world, I wanted to take you back to a video I did very recently talking about Latin America and a video I did talking about China and Germany. The Latin American video was talking about the emerging market economies burning up. Their currencies are devaluing, their stock markets are falling, and their overall production is coming down. And that's big because they're big producers for the world. They produce a lot of goods in general. And emerging market economies overall are an early indicator of how the overall world economy is going to do, because they produce a lot of things and provide a lot of the materials, the raw inputs for the industrialized nation output. And so when their economies fall, it's an indication that overall the economic overall picture for the world is falling. And in particular, I did a video on Germany and China and stated that Germany and China's markets are coming down, their currencies are under pressure, and those are big manufacturing centers for their region and for the world, and that's an indication we're sliding into a recession. So with that as a backdrop, we're going to look at auto sales in Germany and China specifically. There's an article printed at Zero Hedge in early October of this year talking about how auto production and sales plunge in Germany and Brazil. Of course, in that Latin American video series that I did, we did talk about Brazil and the problems that they're having. Basically, their political decision to go into socialism, the pressure on their currency, and the economic issues that they're having. Here we're going to talk more about Germany, and here's a chart in the article talking about German motor vehicle production, and we can see that it peaked about the same time the U.S. market peaked in 2015 to 2018, here with an index almost 115, but it has fallen this year precipitously over 30 points to the low 80s. That's about a 28 to 30% drop overall in the auto production, German motor vehicle production. That's a big indicator that demand has fallen and may continue to fall. And it's both a leading and a lagging indicator. It's a lagging indicator because this production will fall after demand falls. So what will happen is demand from the consumer will fall. The dealers will stuff their lots with vehicles expecting sales to continue. When they don't, they'll say, hey, we've got too many vehicles. We need to liquidate these. They'll start dropping prices. And at the same time, they'll go back to the manufacturers and say, hey, can you give us more incentives because we're not selling vehicles? After this goes on for a while, the manufacturers will say, well, we can't incentivize out our entire production. So we need to decrease production because we're having less demand. And let's work out our existing inventories. That way that they're actually able to still make a little bit of profit and not glut up the system with too many overall vehicles, because if they build too many, then the price will fall precipitously because there's too much supply. So that happened first, the consumer having less demand, and then the production fell. So it's a lagging indicator in that the demand fell first, then the production responded. However, it's a leading indicator because Germany is one of those big producing centers for the world, that the world itself is going into a big recession. And when you add the German production with the China production, I think you'll see here that that's an indicator that's the whole world and not just certain buyers of German automobiles. There's an article from Seeking Alpha that came out just a few days ago talking about how China auto sales have plummeted. It says automobile sales in China plummeted 11.6% in September to 2.39 million units, according to data from the Chinese Association of Automobile Manufacturers. Passenger vehicle sales were down 12% during the month. And the most key point here is the third bullet point where it says, the monthly drop was the largest in China since 2011 and marks the third straight month of declines amid trade issues. So now the issue that we see here is there's the biggest drop in Chinese production since 2011. That's 7 years. That's a rather large time frame and can be an indicator of the strength of that drop. When it drops, over a 7-year period, that's a strong drop. That indicates a large issue with demand for those vehicles. And when you look at the German production falling 28 to 30% in the span a very short period of time during 2018, that is also a very large drop. So now that we can see that the strong emerging market auto producers are falling precipitously, that's an indicator that global demand is coming down precipitously. And when we add that to the fact that in the U.S., it looks like we've already reached a cyclical peak in auto sales and we're starting to come down. Now you see the picture around the whole world that the auto production is coming down. That means the demand is down. That means the consumer may be levered up and may not be able to take on any more loans to buy these vehicles. And certainly people that can afford to pay cash for vehicles will always do so when they want to do that. But most people finance them, and this is an indication they cannot take on any more financing. Even at the 0% interest rate and even with the discounted prices, all the deals that the manufacturers were providing to the dealers and that were passed on to the consumer is a very strong indicator that the auto market has slowed down, has reached a cyclical peak. Now, when you add that to the video I did recently talking about the peak in real estate as well globally, where we're seeing prices fall in London, Vancouver, inventory starting to punch up in the United States and sales falling in the United States at the same time, we're starting to see a weakness in the real estate market. And real estate and autos are two of the biggest purchases people will make on finance in their lives. This is an indicator that people don't have enough money to take on any more debt. They're leveraged out. And when consumers get leveraged out, that's a big indicator the economy is about to fall because they need to work out that leverage. So we're going to buy less. That means economic production and sales are going to come down. That means we're going to go into a recession. And the strength of that recession is dependent on how much debt needs to be worked out first before we can recover and consumer demand can pick back up and stay up for any length of time. And previous articles I've done have indicated that I think this is going to be a very deep recession because of all the leverage that we built up across the world since the last recession in 2008 and even since 2000 when we had the tech crisis as well. Here's an article from Fortune magazine talking about the slowdown in auto sales. But they're really discussing it from a trade war perspective or trade policy perspective. And this was printed, August 28th. So they're talking about the tariffs that the Trump administration is enacting, putting a dent in sales and really affecting the market. And I think that this is a little disingenuous because, first of all, they don't spend a lot of time talking about it. There's not a lot of data here. I'll read you a paragraph. It says, In the last 8 years, car sales have grown by an average of 5% per year, but in 2018, that rate is expected to slow to a mere 1.8%. They're talking about in the United States. The Wall Street Journal attributed the shift to global uncertainty over Trump's trade policies, which are undermining consumer confidence, raising prices on raw materials, and creating new barriers to the import and export of vehicles. They're trying to build, I think this is a straw man, because they're talking about a slowdown in U.S., but they're not bringing data from around the world to say that it's really slowed in the rest of the world much faster than it has in the U.S., okay? And then they're trying to equate what's happening in the U.S. to overall world confidence issues in the market. But in reality, the slowdown in the auto market and the real estate markets happened before the tariffs did. So it's like they're trying to put the cart before the horse, and they're trying to blame it on the wrong thing. I really don't buy this argument. I do think the tariffs are going to they're going to continue to make the issue worse than it otherwise normally would have been, because it's going to make imported vehicles more expensive, and that probably will goose demand for domestic vehicles. And as much as the local manufacturers who don't have a large reliance on outside parts to build their vehicles can build cheaper vehicles, it will goose U.S. sales. But I think it will affect overall auto sales. But this is not the cause of the slowdown in the auto market. This is just being tacked on after we started seeing the weakness in the auto market. I think the trade policies are a reaction to a slowdown in the economy, and as well as the current account deficit we have with some of our trade partners. And it's not the cause of, it's a reaction to that's going to make it worse, but it's not the cause. So I don't really believe this Fortune article. In doing some other research, I came across a chart at Value Penguin that's talking about loan rates. And I just wanted to go over this because it really shows how the cheap credit led to the boom, but also as the rates rise, it may lead to the bust, if you will. So in 2000, right after the tech crisis, we had high interest rates of about 9 to 10%. They've came down to a low, I would say, of right under 5%, maybe about 4% for auto loan rates, but they've spiked up. It's well over 5 and on its way to 6. So as these rates have spiked up, and they spiked up over the last couple of years, you can see how that's put pressure on the market, because as interest rates go up and that raises the cost of financing, it raises the total cost of ownership for that vehicle, and that will reduce the amount of vehicles that can be purchased by the U.S. consumer, and that's really affecting the ability of U.S. consumers to continue to buy vehicles. And there's another chart in here I wanted to look at with you guys as well, looking at the creditworthiness of people buying cars, for example, that take loans. A whopping 15% have a FICO score between 500 and 599, which is not good. It's subpar. Another 14% subpar under 619. Another almost 10% subpar under 659. Another 7% subpar. So really, until you get about 720 credit score, you're not considered to be in the best range. This is the best range. Only about 4% of people are buying cars in this range. That's for two reasons. One, they probably can afford to pay more in cash, and two, they're probably a little bit smarter holding their vehicles longer, just to be honest with you. People that refinance out of cars a lot tend to be in the lower credit score bracket, the lower income bracket, and they tend to bring a lot of bad debt with them from vehicle to vehicle, and it tends to cause more pressure on their loans over time. And this is a very interesting chart, and it's showing the overall health of people taking auto loans. When you have this many people subpar credit taking auto loans, when those interest rates rise, it cuts them off from the market. And because it means there'll be basically more defaults. And so the auto manufacturers have a choice. They can lend, or they can continue to lend to people with bad credit, but there's going to be more defaults as rates rise, and they're going to have to tamp that down, or else they could go insolvent themselves. They could go bankrupt. So they can tamp that down, and what that's going to do is result in lower sales. So as interest rate rise, we can expect lower auto sales in the future. So as interest rates rise, this will continue to fall, maybe to 16 to 15 to 14 million units. We'll see. And as we go into a recession, we'll see what happens. Will it be cut in half? So two things I want to talk about. If you're an investor, it now may not be the time to invest in automobile sales companies, because it looks like their ability to sell vehicles is going to go down in the future, and the profit margins may go down. And because they've taken on a lot of debt to finance this production in a very competitive auto market, it may not do very well for their stock price. And if you're a consumer and you're planning your personal budget, you really have to consider whether it's a better idea to buy a new vehicle now with rising interest rates, where you may get less car for your money, or whether it be better to fix up your existing vehicle. What my wife and I have chosen to do is fix up our existing vehicle. So we've taken care of all maintenance. It's all current. We rotate our tires very often. We take good care of our vehicles, and that's a lot cheaper than buying new ones. We don't have, two $600 a month vehicle auto loans that we have to pay for, and that allows us to take care of our vehicles and save the rest of that money and pay down debt elsewhere. And that's a good thing to do in a recession. You want to deleverage. The consumers are going to have to deleverage into the next recession, and the faster you do it, the better it will be, or the quicker the recession will be over. The same thing will happen to companies. They'll have to deleverage during the next recession, as well as the U.S. government will have to deleverage during the U.S. recession. And when the government deleverages, that means less money for entitlement programs and less money for infrastructure spending, which means that people will have to be in better personal financial position to handle the government spending less. So these are the things you want to think about going into the next recession. The reason I put this video in the basic series is because this really only took about 10 or 12 minutes to understand and to research the auto market, and it is a leading indicator for when we're going into a recession. And so that can be a good piece of data for you guys to keep up with, both from a understanding the economy perspective, what to invest in perspective, when to invest in the auto market, when not to, and how to plan for your next vehicle purchase from a personal budget perspective. If you guys like the video, please give it a thumbs up, subscribe, and until next time, this is Rob on the Suey Jurors channel.